Imagine having the wisdom of one of the greatest investors of all time at your fingertips, Warren Buffett, known as the Oracle of Omaha. Today I'm excited to share the Buffett blueprint. Let's start with value investing, a cornerstone of Buffett's philosophy. Buffett famously said, "Price is what you pay. Value is what you get." This principle emphasizes the importance of focusing on the intrinsic value of a stock, rather than its market price. To practice value investing, look for companies that are undervalued by the market, but have strong fundamentals. These fundamentals include robust earnings, manageable debt levels, and a competitive advantage within their industry. By identifying and investing in such companies, you can make informed choices that are likely to yield substantial returns over time. This approach requires patience and diligence, but it can significantly enhance your investment outcomes. Next, let's discuss the importance of a long-term perspective in investing. Buffett emphasizes, "Our favorite holding period is forever." This mindset encourages you to think of your investment as ownership in a business, rather than just pieces of paper to trade. By adopting a long-term perspective, you can commit to holding onto quality investments through the ups and downs of the market. The idea is to benefit from the growth and profitability of the businesses you invest in, rather than trying to time the market for short-term gains. This strategy not only reduces the stress of constant trading, but also aligns with the natural growth trajectory of successful companies. Another critical aspect of the Buffett blueprint is thorough research and due diligence. Buffett advises, "The best investment you can make is in yourself." This means educating yourself and thoroughly researching any potential investments. Don't just invest in a stock because it's popular or because someone else recommends it. Instead, dive deep into a company's financial statements, understand its business model, and evaluate its potential for growth. Look at factors such as revenue trends, profit margins, debt levels, and competitive positioning. This diligent approach reduces the risk of investing in overhyped or fundamentally weak companies and increase your chances of long-term success. Let's talk about the importance of avoiding market fads. Buffett warns, "Be fearful when others are greedy, and greedy when others are fearful." This advice highlights the dangers of following the crowd and getting caught up in market trends. Many investors are tempted to jump on the bandwagon of the latest hot stock or sector, but these fads can be fleeting. What's popular today may not be tomorrow, and chasing trends can lead to significant losses. Instead, stick to what you understand and believe in. Focus on solid companies with proven track records and strong fundamentals. And by avoiding the hype and making decisions based on sound analysis, you can protect your investments from the volatility and unpredictability of market fads. Now let's discuss the balance between diversification and concentration. Buffett is known for his preference for a concentrated portfolio, stating, "Diversification is protection against ignorance." It makes very little sense if you know what you're doing. This approach involves investing in a smaller number of high-quality stocks. While diversification can reduce risk by spreading investments across various assets, a concentrated portfolio allows you to focus on the best ideas and potentially achieve higher returns. However, this strategy requires a deep understanding of companies you invest in and confidence in your research. It's not about avoiding diversification entirely, but about being selective and informed in your investment choices. Finally, let's talk about the importance of keeping it simple. Buffett often emphasizes the value of understanding your investments. Never invest in a business you cannot understand. This principle is crucial because complexity can obscure risk and lead to poor investment decisions. If a stock or investment strategy seems too complicated, it probably is. Stick to straightforward investments that you can easily comprehend and evaluate. Simplicity also helps you to stay focused on the fundamentals and avoid getting distracted by unnecessary complexity. So, in summary, the Buffett blueprint for investing revolves around key principles such as value investing, maintaining a long-term perspective, conducting thorough research, avoiding market fads, balancing diversification with concentration, and keeping your investment strategy simple. Remember, as Buffett wisely puts it, it's not about timing the market, but time in the market. The goal is to invest in quality businesses and hold them for long term, allowing your investments to grow and compound over time. So start today, and you might just find yourself on the path to financial success, guided by the timeless wisdom of Warren Buffett. See you in the next one.